Hi, everybody. Super excited for this session with Lucas Casarez, who is a financial planner and has done sessions for the Collab Lab before. There's not to steal his thunder, but as you're making your way into tech, a lot of times it's kind of this like life-changing bump in salary. And so it can be disorienting. It can, there's some risk involved there, but there are also ways that you can kind of be smart about it, to take real advantage of it, to kind of set yourself up for success. So Luke's going to talk us through all that, kind of the mindset, and then feel free to ask questions in Dory if you want, in the chat if you want to as well. And I think, Luke, you're going to leave some time at the end too for us to kind of get to questions. But if things come up through the course of it, and there's like we're on a particular topic and you have a question about that, feel free to either put your hand up or just ask in the chat or something too. But that'll turn it over to you.
Yep. Thanks, everyone. Nice to meet everyone. Happy to be here presenting at Collab Lab, a great organization, as you all know, and I'm excited for all of your features. If I'm not following you, I'll probably end up following you at some point on Twitter, and it's always cool to see people make their transitions, whether it's that first job or that kind of second one where it's like a huge life-changing event, the dream jobs and things like that. So it's always fun to see people as they progress through their career from this point on. I will pull up kind of the slides that we'll walk through, but definitely ask questions. That's where most of the value is going to come from, just because I know the types of things that are going to pop up is going to be specific to things that you have going on, thoughts that not just you have, but that always occurred for a lot of people in your situation. This is recorded too. So in addition to the people that are here that you see their faces, it might help them if they're not comfortable asking the question. I might be able to answer something for them, as well as future collabs if they end up popping into the recorder and just to kind of peek around. Today, we will be talking about navigating finances during a career change. I fell into this topic and kind of realized it when I started my company. I ended up working with a lot of people that went through tech boot camps and saw how ridiculously life-changing it is, as far as making 30,000 to making 90,000 just within a few months of graduation of a boot camp that they ran through pretty quickly. And so, as Andrew mentioned, could be disorienting. There's positives to it. If you don't do the right things, it could easily turn into a negative if you start to establish bad habits with all that new money that you could be doing. Some good stuff, definitely still enjoying it. And we'll talk through how to think through that stuff, how to be more intentional, kind of plan as you're navigating those things. There's this quick little slide about me. Those are just two of my four. That was before the pandemic, I think, shut everything down. That little guy is going to be 5 here soon. And then I have a 3-year-old, I have a 1-year-old, and a 7-month-old, and a dog. So we're pretty busy from day to day. Live and love in Colorado, originally from Illinois. Both me and my wife were, and now we've been in Colorado for about 11 years. So most of our adulthood here. And I started my company 2017. It's Level Up Financial Planning, created specifically to help people kind of navigate their financial life and just have more confidence, have a better understanding of, well, I'm never going to tell anyone like this is what you need to do. This is like a holy grail rule. It's more of, let's make sure you're educated, aware of all these cool different possibilities, and plan for them now so that you don't kick yourself in the future and be like, man, if I would have known, I probably would have done things a little bit differently. And again, that's one of the beauties about this transition that you're all working through right now, is this is that kind of moment coming up where you get to make more decisions, have more control, have more power over your future than ever before. And making good decisions is definitely going to help make life easier, make life more fun all along the way. I also started taxes, so that's something I'm knee deep in right now, in addition to financial planners, just kind of helping my clients do the tax stuff. And it wasn't something that was a huge passion of mine, but I do tax planning. And after 3 years of clients constantly asking, like, hey, can you do taxes for me? And then seeing the work that their tax people that they were having to bounce to wasn't really up to speed. I was like, I guess I'll do taxes. Surprisingly, it's been a lot of fun. Used to make a lot more podcast videos, strategy guides, and cheat sheets. Still have a lot of those available as a resource. So if a question ever comes up, even if I don't have a resource kind of in my arsenal, I'll be able to find a good one that I trust, that I could always shoot you a link to. But those have been fun, and I'm definitely getting back to the podcast and here once tax season's over. So be on the lookout for some of that fun stuff, and always feel free to suggest a topic if you ever want to see something specifically. Tonight, we're going to talk about how to be financially successful, kind of what I think that means, how to go from just surviving to thriving, which sometimes it's a situation where you're already in a well-paying job, you just don't like it, and so you're making a career transition. But I do know that a lot of people, sometimes it's just like, hey, I'm not making enough for where your goals are, or to have more control, or just be kind of fulfilled in those roles. And so it really is a difference of going from survival mode to all of a sudden being thriving, having choices and options. And we'll talk through what to think about, some of those things to just explore a little bit more. Everything that we're going to talk about today is kind of going to be high level, just to kind of give you the idea of how much further you can dive into this stuff. So if you find something that you want to dig into deeper, definitely reach out. I might have a resource that will kind of take you specifically to that, but Google, as engineers, people in tech, I'm sure you're really good at Googling at this point. That will help as well, being able to hunt down, dig into deeper details on some of these things, what to be aware of in tech too. Again, there's just like any place, any situation, there's definitely mostly good things going on, but there's a few potholes, some things you want to just be aware of, so that you know how to sidestep them and not fall victim or into those traps. Then time for Q&A at the end for sure. These are just disclosures saying this is not specific recommendations to any one of you. It's more just educational purposes, kind of to give you a general idea of what to start thinking about. And then, yep, when you want to dive in deeper, Google, research, buy books, watch YouTube videos, whatever it is, to kind of take that financial competence to the next level. You can definitely do those. And before we dive into kind of the meat of it, I want you to kind of think about how much does money impact happiness for you personally. There's been studies about specific dollar amounts, and those are good. They're going to vary from wherever you all are located. It's different for me here in Colorado than it is for Andrew, than it is for Viviana, Kristen. I don't have the ability to scroll down quickly on this kind of name everyone, but everyone's probably more or less in a different location. So the numbers might be a little bit different. But at the end of the day, it's not so much about the numbers. It's not so much about the income or what you can buy. It's more about internalizing like what it is that actually is going to make a difference in your life, what actually matters to you. And then kind of backing into that, once you are doing everything that matters, no amount of money above that is really going to add a ton of happiness. And so being able to think through this, and I'll give you a little bit of framework of how to go about just kind of exploring it. No one knows for sure. It's just like how you don't know for sure that you'll be in tech forever, or if you had another career previously, you didn't know that you're going to be making the sleep to tech. It's all kind of an adventure and exploration and just kind of discovery that you can choose and decide what that looks like. And it's good to figure out what's going to make you happy today and what's that goal right now, knowing that it's perfectly okay to be flexible and change and pivot and follow what it is that's gonna be that new happiness that the next month or next year. So how to be financially successful? I don't think you need to make six figures to be successful. I actually know you don't have to. I know a lot of people that have not. Even before I was making six figures, I know that we were doing well, we were successful. And again, it just kind of comes down to narrowing in on, well, what's the most valuable thing? And then allocating your resource to making sure that you're establishing good habits, being disciplined. A lot of this stuff, if you're into fitness or have ever been kind of through cycles of fitness, it's a lot of the same stuff sometimes, where it's just like, hey, if you're disciplined, create good habits, you're usually going to be healthier. Same thing on the finances. If you're disciplined with your money and create good habits, you'll probably be feeling pretty confident and pretty stable about your financial situation. But also with fitness and health, like I know I could all of a sudden go out and eat a whole pizza. Well, that's probably going to set me back a little bit. Just like you can just go and buy a brand new car that maybe wasn't on your goals, but you just kind of caught a wild hair and went out and pulled the trigger on something like that. So easy to create setbacks, and setbacks can be big, setbacks can be small. And at the end of the day, financial success is going to be similar to any other type of goal that you achieved. If you've gone through a boot camp and graduated that's a huge achievement. Most of us have finished high school. Some of us maybe finished college or finished a semester in college. Like all these things, it doesn't matter if you meet the formal completion, just as long as you kind of gain value as you're kind of moving along. And yeah, everything's kind of like an achievement and milestone if you kind of break them out to be and are able to pull something valuable out of those experiences. So if you wanted to draw a quick plan, just you can do it on your own. That's one of the beauties of financial planning. And again, kind of can relate it to fitness. Like most of us know what to do as far as fitness wise to be healthy, like eat good, exercise, and that's pretty good. It's sometimes easier said than done. Same thing with the quick plan. You can just say, you know what, I just need a house, just bare minimum food. I don't need to go to Whole Foods. I don't need to go out and eat all the time. Like there's different levels, and we can pick and choose what it is that's important to you and what's going to add value. And that's one of the reasons why I love financial planning, is because there's no plan that's the same. Sure, everyone probably has some form of retirement, but what does retirement look like for you? And are you going to travel? How much travel? What types of wine and like fun trips are you going to do kind of all along the way between now and then? What types of cars? What types of house? Are you going to set yourself up to be able to take sabbaticals and things like that? So you can do whatever you want to do. And it's just kind of creating that own roadmap for yourself as far as defining what the rules are to being happy, defining what the rules are to being financially successful. And it just takes time. It takes intention. And so that's where this plan will definitely help, just thinking about things proactively instead of constantly reacting and constantly feeling like you're I used to be really into boxing, but if you can imagine, if you don't plan ahead, it's kind of like what happens for a boxer that's not prepared, steps in the ring, wondering what the heck he's doing here. Before he knows it, he's being hit multiple times. He's just trying to just dodge and stay alive at that point. A lot of times that's how people end up dealing with their finances, is school education systems. They're getting better now for high schoolers today. But for any of you that are my age, probably anyone that started high school before I did, this wasn't a big topic. It wasn't something they spent a lot of time on. I had to go to school specifically to become a financial planner and kind of get those experiences and expertise. And a lot of it has come from working with a variety of clients, because there's different scenarios, different things going on. So the biggest, most important step, I think, to just being successful, whether it's finances or anything, is just believing you're capable of it. There's a lot of studies that show just confidence is a big thing. Sometimes it's us kind of setting our own roadblocks and being like, nope, I don't deserve to do this. And that might be a shock too. I've talked and heard that a lot from people that go from all of a sudden 30,000 to 100,000, like that imposter syndrome starts to creep in. Like, I don't deserve to be making this much, like not where I came from, or not the mistakes I made in the past or whatever. And those things are definitely limiting, self-sabotaging kind of thoughts. Anyone can make that decision today, no matter what bad financial decisions you may have had or circumstances. It might not necessarily that you're in a position to even make bad decisions. It was just circumstances and kind of background that up until now you didn't have the ability to do these things, but you will have that capability breaking into tech for sure. Like I can guarantee it. As long as it's a position and something that you're enjoying, the money will definitely be enough to make you financially successful. You're not going to become a millionaire overnight, but no one is in most lines of work. It takes consistency, good habits over multiple years. And you talk to a lot of the older people in tech, and a lot of my clients, even, I'm surprised by how some of them lived in their cars and were way behind on rent and things like that. And I was like, wait, you worked in tech though, like the whole time? Like, yeah, but I had student loans and like finances are always hard earlier in your career, unless you just had a lot of assistance from parents or grandparents, something like that. But yeah, even the people that you look at and you're like, whoa, they're doing really well. They got a nice house and they're older. Like there's a good chance that they probably struggled in the early 20s and probably even up until their 30s. It's been a surprise for me to kind of hear those old stories from some of my millionaire clients. Like, wait, like you seriously had like that issue where your car was about to be repossessed and now you're in this situation. And it just takes time, it takes consistency. Identify the meaningful goals. Where a lot of people struggle here is we've always been told what to do, what's important, what we should aim for. And as an adult, sometimes you just kind of, life gets busy, life is hard. You know, like, yep, let's just do what my parents said, or let's just do what my grandparent always used to tell me, or let's do what my friend's doing right now. The hard work is really just taking the time and just trying to really identify what it is that you think is going to make you happy, not only with the things you're doing today, but some of those longer term goals too, what it is that you want to aim for. And you can change your mind. I never knew I was going to start my own financial planning company. Good thing I was saving when I was working as an employee, because we ended up needing pretty much all of those funds in order to make this kind of work and be successful over the first few years. And so identify what those goals are for you. And even if those goals change, most likely because you're moving towards these things, you're learning, making good decisions. When you pivot to whatever that new goal is, you'll be in a better spot for it, have a lot more resources to be able to navigate those things. Just mention resources. Look and see what you kind of have available. That's going to be your income primarily right now as you're early in your career. As you get later in your career, homes, rental properties, 401ks, there's resources start to become more abundant. And the later you get in your career, you'll realize that your income is less of a resource because there's only a few more years left of kind of applying that. But then these other things start to be pretty large and dramatic for you. So that's step 3. And once you have that, even with an Excel spreadsheet, it's not going to be 100% accurate, but you'll have at least a decent idea to figure out, like, am I somewhat doing okay? Should I be panicking? Should I be making changes now? I think that's the big point of figuring out whether you're on track. If you're not on track, well, let's find out what actions, what changes you can start to make, what types of milestones, and have that plan of attack to be able to not necessarily get to $1 million by the end of the year, but save that first 25,000, save that first 50,000, and start to build these milestones. And one of the cool things about finances is it's very easy to identify what those milestones are. It's a very specific numbers-based situation a lot of time with your finances, and you usually want to look at the whole picture. Sometimes I'll see clients who are doing like really awesome, and I'll hear some frustration in their voice, and then we kind of have to pull back and be like, hey, you're focusing on your savings account, and maybe your savings account isn't growing every day, but that's because we're throwing so much at your retirement right now. That's because you're paying a mortgage on a house, which is an asset for you, and you're building equity. And so there's a lot of head games and different emotional things that you'll run into with your finances. And having a plan and being able to kind of step back from the plan and look at everything is always going to help you just make better informed decisions. And then plans are ever changing because our goals and life situations, we get new information, get new ideas, new exciting things that, well, what happens if we make this pivot? Well, you already got that base plan. Now we'll do strategy guide 2.0, 2.1, whatever it is that next update's going to look like, but you'll be way better off from having an initial plan instead of just kind of like that fighter that I mentioned, where don't have a game plan. What the heck am I doing here? Like how do I do the right thing and avoid making mistakes? And the best way you can do that is have some relative idea of where you want to go in the first place. Perfect. And I'm just going to pause right here, kind of check into that Dory. Should have broke it out to a different screen here. Any questions?
I have a question there, but it can wait till the end.
It can wait till, okay, perfect. So we'll continue on here. So what's the difference between being successful versus being struggling? And you might be surprised, but I've had clients and just people I know that make $300,000, $400,000, worse position financially than a client making $70,000. And the reason for it is because they're not necessarily disciplined and didn't necessarily have a plan from the get-go, and their expenses, their decisions just kind of put themselves in a really financial bind. Even though they have a lot of income coming in, it's all going out somewhere, and they're struggling from a cash flow, from a stress situation. And so on the left side, that's kind of a successful way of just at least planning on your month to month, week to week type situation. So look at your income. Unfortunately, you have to pay taxes, as that's one of the requirements. So you don't want to forget about that. Try to put taxes at the end, because it's never fun to come to tax season and be like, holy smokes, I owe how much? So taxes, you want to account for that first. Savings will be that very next thing that you do have control and a decision over. It's good once you get into tech and you have some more kind of flexible income, disposable income, to say, well, I have a wedding coming up, or I have a home purchase that I need to start saving for a down payment. Whatever it is, the goal that's important to you. It doesn't have to be retirement. It can be whatever these goals are that are going to help move the needle, kind of make sure that you don't go into debt to fund a wedding, or to fund what are the honeymoons after the wedding. So one of the things that happens a lot is like, hey, I got a good paying job. Let me just spend like 25,000 here, 30,000 here. And all of a sudden you realize, well, after taxes, you might not have as much money as you think you did for all these things. And you start to go into credit card debt and credit cards. I'm sure someone has experience with it, or knows someone that has had experience with bad credit card debt, where it's 22%, sometimes worse interest rates, and those become really tricky to navigate. So being able to prioritize savings when you have the funds, when you break into tech and have that income, you definitely want to plan for that first. That's one of the big differences, right? So the person struggling on the other side, if they do have savings, it's at the very end. And what most people realize, when they put savings as the least priority, there's never savings, basically is typically what happens. Then they kind of break things out between needs. So what do I need? I need housing, I need food, I need safety. And then wants. Wants is, hey, after I do all these things, I know that any money left over is for the fun stuff. So I don't have to worry about it. I'm already saving for my goals. I already am on track there, covering all the stuff that's important, that is required. And then if there's fun money left over, then that's where the fun stuff is going to come in, and you can do it guilt-free, stress-free at that point. Another difference is needs and wants get jumbled up for the people that are struggling. Their wants feel just like needs, and they can't kind of disseminate between the two. And when things come up, a random expense, oh, I gotta fix a car, have to get a car towed, something like that. Well, that's money that maybe you weren't planning on spending. And it's hard to, when you go and look at your needs and wants, you're like, I can't cut anything here. I need it all. But most people, especially when they have the tech income, they have some wants in there. They have some extra, a little bit nicer things, fancier things, that when you don't break them out, it all just feels really important. And it's really hard and stressful to be like, oh, I can't go to Starbucks, or I can only go to Starbucks a couple times a week. And not to pick on anyone that drinks Starbucks, I used to be super addicted to it. It's whatever those weaknesses or those wants are for you, that sometimes get really ingrained, where, yeah, there's substitutions that you can make if a dire situation comes up, and being able to have that flexibility because you have a clarity as far as, well, what's a want and what's the need kind of portion of those things. So from surviving to thriving, and again, I can only imagine that it probably accounts for at least one of you here, that financial income situation is just going to change dramatically. If not with that first position to get that initial experience, what I've seen with my clients is that second or third one really gets some lift off there. And there's just a lot of opportunity to catch up, or if you're already doing really well, kind of start to pad some of the things that you've already been doing good at, and just have some more breathing room to be able to relax, not feel so stressed, not feel so like, oh, that hopefully payday comes before another miscellaneous expense pops up, or emergency expense pops up, because I can't really deal with that stress right now. Like it starts to become very different, and it's crazy how quick that can happen when you make this big change that you've all worked hard to make. So being able to start building up savings, building emergency savings, it's not exciting at first, but once you have that emergency savings there, it's always hard for people to be like, oh, there's something that could come up, and they have money there for it in a savings account. But no, I just hit $10,000. I would rather keep that there, put off spending on this, and I'll actually just save monthly for this specific goal. Where things start happening, kind of confidence wise, emotionally wise, once you start hitting these different milestones, and you don't feel it right now because it just feels like a pain, like what the heck, like I have to save how much as far as the rules and recommendations. If you look online, it might be 3 months or 6 months, depending on what you're looking at. Don't worry about that. Break it down into those smaller milestones. And once you hit those things, it's going to feel really good to have that first $500 free and clear, not have to worry about if something comes up that all of a sudden you're going to credit card debt or having to ask for money, things that occasionally happens when you just kind of have such a narrow span of income that can't stretch as far. Being able to pay down debt. So especially if you've had to take time off during a career change, it might be credit card bills and things like that, where these things are super heavy burden. It's a huge weight to kind of carry, but making that dramatic jump in income, you can really aggressively pay these things off. That's one of the things that we prioritize a lot with some of my clients that do make these big changes. Like, all right, how painful are these things? And that's going to prioritize how much money we throw at them. We also want to make sure that we're aware of those other goals. Like, is there a wedding? Is there some other big things? And then we start to kind of drop them down timeline wise, make sure we break it down. Well, how much a month do we need to save for this? How much does that leave over for us to just kill off this credit card as fast as possible? Student loans is a big one. I know a lot of people have forbearance right now. Through May 1st, there's no rulings on it yet, but there's a good chance, and don't kill me if it doesn't happen, but good chance it might be extended again. And so be on the lookout for that. But if it doesn't get extended, just be ready to absorb that payment that's going to get turned back on. Retirement's a big one, especially where maybe early in your career, first part of your career, you were like, yeah, like what is retirement? What is a 401k? I've never had any of these benefits. I don't know what this means and if it's even worth it to do any of this stuff because I'm so far behind. Well, again, I've had clients, I've seen people go from way heavy debt, no assets, no nothing other than their new income. And if you jump $40,000 in income and you're getting by okay, well, that leaves a big chunk to be able to start moving towards these goals pretty massively and quickly. And one of these clients specifically, he's going to take a whole year off next year. Him and his wife, they're getting married this spring. And then next year, they're both not working. They might buy a house in Puerto Rico first, or they might not buy a house and just kind of travel all over South America and stuff like that. And it was about 3 years ago, I think he graduated his boot camp, and the salary jumps have been crazy, but he's been really good and proactive with figuring out what these goals are, the things that he wants to achieve. And then, yeah, like he's saving enough, doing enough, keeping his spending low enough to where he can not work for a whole year, even though he's only been saving for three years towards this stuff. So can be pretty dramatic. And you can start to catch up on that. Protection, that's going to be things like life insurance. Anyone that has a child, a young child at least, needs some form of life insurance, and usually it's more than what your employer is going to provide. So things that used to be a luxury, like I can't really afford $50 for $1 million of life insurance. Well, you should be able to afford it once you kind of get that first real tech income flowing through. If you have children, $50, $25, whatever it is based on your age and health, pretty easy cost to just kind of cover and make sure that they'll be fine, even if something were to happen to you. But I know that is a luxury for those who aren't quite there yet. And you guys are right on the doorstep, so if you're not there just yet. And then don't forget to pay taxes. I think one of the biggest things is taxes aren't necessarily bad. You always get more money. The more money you get, the more taxes you pay, but you still end up with more money essentially. So it doesn't feel good. It's never going to feel good paying taxes, but it's usually a good sign that you're paying a lot of taxes, because it means that you're actually bringing home a lot more than what you were previously. And it's kind of like a love-hate thing, perfectly healthy, perfectly normal. Yeah. Any questions through this point? Nope, wait until then. Perfect. So this one, I like kind of this. This is going to be a lot of the common questions I get that I'll just kind of hit on really quickly. And I call it this or that. And so term life insurance or whole life insurance, I just kind of mentioned, well, life insurance is important to have. But when you're in tech, when you know that in the next 15, 20 years, you'll actually be pretty successful financially, because you're, if you have a home, or if you end up purchasing a home in the future, you're going to have a whole bunch of equity in the home. Mortgage will be a lot smaller. Your retirement assets will be a lot larger, because you'd be contributing there. And yeah, you just don't need life insurance forever. That's what whole life insurance is. Whole life is like, hey, you're going to pay this huge amount of money forever until you die, basically. Term life insurance is, I don't have assets. I don't have any resources right now to actually support my kids if something happened to me today. So let's figure out a reasonable time frame that we need that protection. Usually about 15 years, could be 25 years if you just have little young ones like I do, like the 7-month-old. Well, I probably want something for at least another 18 years. And you kind of pinpoint that term to what you want. And because with your life, there's a chance that you might not pass away. There's hopefully a good chance you're not going to pass away with term life insurance. It makes it a lot less costly. With whole life insurance, since it's going to cover your whole life, well, you're going to pass away at some point. So that's why it ends up being more expensive. There's also some other funky things that they add into there that increase costs that a lot of people aren't aware of. So usually term life ends up being the best for most people, because you get the coverage you need at a lower cost, and then it allows you with the difference to be able to save into retirement, save towards those other goals that are important to you. And whole life insurance, rare situations, business owners need it if they have business partners. If you have a child with special care needs, where it's like, hey, yes, when they're 40, they're still going to need someone to take care of them, even if I pass away. And so I need this always around, so I'll provide care or something for them. So whole life insurance, the need for it is fewer situations and a lot rare. Unfortunately, this is where life insurance agents get paid the most. And so that's the only solution a lot of times that people are offered. I'll tell clients, I'll put in word and use this word when you work with your preferred person. And sure enough, they just jump straight to this. And I'm like, that cost looks a little bit higher than what we're expecting. Ask them if term life is available. And sure enough, like they could sell term life, but they get paid a lot smaller amount. So it's unfortunate. And yeah, definitely reach out if you have any questions. If you happen to have whole life insurance and you just kind of want a second opinion on it, just ping me a message, send me some details. I'll kind of tell you what I think about the situation. So debt repayment versus 401k contributions, really big topic, not even for people making this transition, but again, even people that have been in tech since 22, 21, if they graduated early or just jumped from high school to working, it's hard those early years. So it's very easy to have debt. And my thinking is those higher interest debts, so typically anything above 7% is really high interest rate. So you're paying a lot just to have that money being lent to you still. That's really high. That's where it starts to become more of a priority to pay off the debt for lower debt repayments. So if you have a mortgage, you might only be paying 3% or 4%. That's really low. It's really cheap to borrow money, especially on a mortgage. So not as worried about trying to pay off your house as fast if there's other things that you might want to do in order to kind of reach your goals a little bit faster. With 401k contributions, bare minimum, if you get an employer match. So let's say a common one is, hey, if you put in 3%, your employer's going to put in 3%, get that 3%. That 3% is, if we're kind of comparing it to an interest rate on debt that you're paying money to someone else, the 401k with that match of 3% for your 3%, that's 100%. So 100% to you is still better than 22% to this credit card company, is kind of the way I look at it. So always get your match first. Once you get to that point, if you have that high interest debt, then then start cascading that over to the debt repayment there. One thing I won't dive into just yet, if unless we end up having a question about it more specifically. A good thing to look at, just a term if you want to do a Google search, is called debt snowball. Effective way to, if you have more than one debt, to line up your debt and figure out, well, what's going to make the most impact and be the most beneficial. Which one should you pay off first? Because what I see is a lot of times people just spray everywhere. Like, hey, I got 6 credit cards. I'm going to do $50 here, $50 there, $50 there. You're not going to make the progress that you think you are, and it's going to be very frustrating. Essentially, what the debt snowball will help you do is figure out what that first one is to pay, put all of your extra money towards that, and then make the minimum payments on the others. Rent versus buy. This one's probably the trickiest one out of all of them. It comes down to kind of life situation, especially right now, where if you're in the middle of a transition in tech, you want to be as flexible as possible. Maybe you're not tied to wherever you are locally. Renting might make sense in the short term until you identify, like, yep, this is where I want to be the next 3 to 5 years. And if you know that and you can afford to, purchasing, I am biased because I've seen what's garnering kind of home equity for myself, my family, for my clients has done over the last handful of years. And so I think purchasing a home usually makes the most sense when you know it's an area that you like, know it's an area that you'll want to be for an extended period of time. Not to say things can't just randomly change, where if for some reason my wife got some crazy dream job and we had to relocate, like, we'd do it, even though we've only been in our house less than a year. And there's just a lot of value to purchasing a property and having that equity go up while you're paying it down. With rent, it's always something that you're paying out, you have a lot less control over. So if rent goes up 10% this year, well, guess what? You're paying 10%, or you're having to reduce your lifestyle for that same amount that you're paying. Once you purchase a house, there's some things that might adjust, like property taxes or home insurance, but the actual mortgage payment, what you're paying to borrow the money, that stays the same for 30 years. And it's a pretty effective way to gauge against inflation long-term by purchasing a mortgage and having 30 years of that same payment, because 30 years from now, that payment's going to feel like 1/3 of what it is today in real dollars. Time versus money. This one is going to change for you, a lot of you. And I don't know if Andrew can speak to this, but one thing I've seen is, as I've gotten older, as I've had kids, like, and just there's a lot going on, I feel like I have less time. So I'm more than happy to outsource as many things as possible. Occasionally I'll pay someone to come shovel my driveway if I'd just rather hang out with my kids. We did that when it snowed, like right before Christmas out here. I was like, I'm not gonna not spend time with my kids on Christmas. I'll pay a happy 20-year-old or 18-year-old or whatever a decent amount of money to do that and kind of outsource those things. But it's a balancing act. You can't just give all of your money away to increase your time, because there's going to be some downsides to it. You're going to find out, well, what's important to you, what things are you good at, and what's your time worth. And everyone kind of has their own number, their own kind of value system for that. But I imagine most of us are going to start to see, if you haven't already, like, time is precious for one, but then also it's just super limited. There's a lot of stuff you want to do. And sometimes, like with COVID, we switched to grocery delivery. We're never going back to a grocery store unless it's just to pick up like one thing while we're already out and about. Like, it saves so much time, especially with 4 kids. Like that's easy money to outsource, and it cost me like $15, $20, and we just try to get as big of an order as possible. So last couple slides here, what types of things to be aware of when it comes to tech. So lifestyle creep, just because you jump from 40,000 to 70,000 doesn't mean you're going to save that full 30,000. One, I know you're not going to, because taxes are going to eat into some of that $30,000 gain, which again, it sneaks up on people. You're like, hey, I got $30,000 more dollars. Well, the IRS is going to take probably about 22%, about 30% probably when you factor in Social Security and Medicare taxes. So you probably got 20,000 extra, or if you do the math. But what happens is all of a sudden you start buying stuff like, hey, I'm not even going to worry about money. I used to worry about money every single dollar I spent. Now I just don't care at all. And you go a little bit too far. And all of a sudden the things that you're spending are right up to that point, and you're just as stressed as when you were making 30,000 or 40,000, because, well, now you created this new lifestyle and you're on the hamster wheel again. Like you need to keep making that money. I had a client that burnt out from tech and was kind of freaked out because he walked away from, I think at the time he was making like 100,000. Just quit. He's like, you know what? I'm probably never going to be in tech again. He went through all the hard work of boot camp. I think he worked about 1.5 years, 2 different companies, pretty toxic. It wasn't good fits for him and kind of where he was at. And yeah, he burnt out. And luckily he kept his lifestyle super low. So he took 8 months off doing podcasting, writing a book, and just kind of volunteering, started doing comedy, stand-up comedy and stuff like that. And so like he didn't let the lifestyle creep reach up to him, but if he would have, he wouldn't have been able to do this. And now he just realized that it was just burnout, it wasn't necessarily tech. He's making a lot more now, about, I think like 150,000 plus stock options. And yeah, dramatically crazy pay increase. He was out on purpose for about 8 months, and he's super refreshed, super excited again about the work he's doing. And he was only able to do this because he didn't let that lifestyle creep reach up to him, because otherwise he probably just would have flamed out. He would have had to push on, wouldn't have been happy, would have had a crappy 8 months, and eventually he would have burnt out and not ever been able to come back. Layoffs is something that's unfortunate, especially kind of startups. Seen it with Peloton, seen it with better.com. They do mortgages, seen it with Zillow. Like these tech companies, really exciting, really cool. When they hit these growth spurts, they hire a ton of people. When growth slows off, they need to start laying people off. So one thing to hedge against that, not to say like don't join these exciting, cool companies. If that's something that's calling you, definitely do it. But have that emergency savings lined up, start to work towards those things. And I've even seen like people where, I think it was like a Peloton, and I didn't know them too well as like a LinkedIn person, had like announced that they started, and then like a month or two later when they started doing layoffs, unfortunately, I was super excited about this. Now 2 months later, no longer working there. So be aware of those things. Usually you're paid well enough to kind of secure and build up some of those resources in the meantime. With some of those smaller startups, they might not have a 401k, they might not have health insurance. And again, not to say it's not a reason not to take those positions, but those things cost, and you want to factor that into your calculations as far as, well, does this work financially? Will it help you get to that next level, at least if you're sacrificing some stuff right now? And then it's not all bad, right? So high income, employer stock, a lot more control over your future, a lot more confidence that you can achieve probably some goals that seem pretty lofty or out of your reach. My client that's taking that sabbatical, he's always dreamt of it, right? But he didn't think that was going to be possible. And so a lot more possibilities come up, especially when you're intentional, know what it is that you want to go for, and really take the time to sit down and figure out, well, what is it that's important to you? What is it that actually matters? Because the money stuff, you'll be able to figure that out once you do the more hard work, which is, well, what is important, what's actually going to matter, what's going to make you happy at the end of the day. You're going to be doing a lot of work, you're going to be pretty busy, and it's going to be hard to find the time to soul search and do those things, but it definitely helps in it, and it makes it's an easy return on value, I'd say, just from taking 10 or 15 minutes occasionally, like once a week, to just think about, well, what in the week was good, what is it that you've found out or excited about, and maybe want to start rearranging goals or defining goals for yourselves. So this brings up Q&A. I saw a chat. Yeah, so been laid off a couple of times, obviously. Was that you, Andrew, that commented?
Yeah, for sure. And you know, I wasn't always. I mean, I used to have a lot of credit card debt and student loans and all that kind of stuff. Got laid off at that point, and then just had to scramble for a job. Like now, if that happened, I'd look at savings and things like you're saying, like it wouldn't be nearly as stressful. So I'm just in a better position. So I think your advice about, you know, like even you have a salary jump, like, you know, spend a little bit on yourself, like, you know, enjoy it a little bit, but also like create a buffer for yourself just in case, you know,
Yeah.
you know, something happens.
Yeah. And I'm glad you said it, like enjoy yourself, reward yourself. I think that's important. I think a lot of times people, when they think about doing the best thing financially, well, that's not fun, right? Like you don't want to save everything. You just work so hard. You just made this transition. Like, heck yes, reward yourself. And then just, again, because you're thinking about other stuff outside of just like giving yourself that big high five today, like there's things you can do where you'll be thanking your past self in the future to be like, oh, sweet. Like, Luke from 5 years ago made this decision, and now it allowed us to purchase this house that's should be our forever house and be able to handle 4 kids growing big and running around being crazy. So like there's things that just doing them and putting yourself in a better position, you're going to be thanking yourself definitely in the future, but definitely enjoy your time too along the way.
There's a question in the Dory. Any idea about the nicest types of benefits someone could request in salary negotiations?
Yep. So it definitely depends on kind of what's important to you. Sometimes the money one's the obvious one, right? The less obvious ones, especially as you're entering into tech, stock options. If stock options can become a little bit more complex or complicated because there's stock options from an employer like Apple or Google who actually has like stock that is valuable today. If you work at a startup and they're giving you a bunch of stock options, that is more of a gamble, more of a lottery ticket, like not valuable today, but hopefully in the future it'll become valuable. But stock options is something you can ask for. And again, it's going to be different if it's a startup company because it might never become valuable. So that might not be where you want to focus unless you have a lot of faith in the company. Stock options are tied to longevity at that place. And so if you're like, hey, this is a stepping stone, I wouldn't prioritize negotiating stock options because you'll leave before you get most of those anyways. Vacation days, I haven't been big on coaching my clients because I don't consider myself a career coach or a career expert, but I do know that you can negotiate vacation days with a lot of companies. So if that's really a thing, like, well, a sabbatical sounds nice, but being able to take 20 days off straight through would be beneficial or just as good of a reset for you, and not have to worry about figuring out sabbatical stuff. Like if vacation's important, that's definitely a common one. Those I think are the most obvious. You can't negotiate 401k contributions. That's a government regulated thing. If a company says they're going to do a 3% match, they can't match you 6%. That would break a lot of rules, and the 401k would get in a lot of trouble. So I've seen people wonder if they could do that. 401k not really negotiable on those things. Yeah, I'd say those are the big ones. Relocation reimbursement. So a lot of times that's just given, especially if they're wanting you to move. They'll do that. You might be able to ask for more. And so that's always an option out there. If you're working from home, well, hey, can I get a home office stipend? So there's small scale stuff, there's big scale stuff. And a lot of times those small scale ones are easy to just add on once you get the main stuff, your main salary composition. And then if you're going to do the stock option piece, if you're going to do the vacation, and then, yeah, those kind of miscellaneous, like, hey, what about my office? What would be nice to have like $2,000 worth of new tech and not be working off the same thing I had through boot camp or something.
You know, as much as companies aren't supposed to ask you what your previous salary was or something, a lot of times they still do. And so, you know, if you had a choice between taking, you know, like getting a better office budget versus like a little bit more salary, like long term, is it better to take the salary because then that anchors your future
Yep.
income?
Yep. Yeah. Even if you think about it, just staying at the same company, and then all of a sudden you get a raise, you get a raise off of that number. The stipend for a home office, less valuable, which is why it's a easier kind of add on at the very end. Like, hey, this would also be nice after you've already kind of negotiated your main income situation. So yeah, on a scale of what's going to add more value to you long term, especially the longer career you have in front of you, getting that higher salary is important, because if you stay at the company, future raises are based off of that. But also if you jump, that's what most companies are going to not necessarily match, but actually outcompete and try to offer you more to lure you away. Yeah, super valuable, because we're talking about recurring income and stuff being derived off that in the future. So definitely valuable there. Good point.
All right, another question. Hypothetically, if someone has a boot camp loan at 10.5% for $20,000, is that a case of you should definitely refinance that loan?
Definitely refinance it if that's an option. Most people can, and it might not be like way better, but I've seen and recommended a few times like a 5% or 6% student loan refinance. You got to work with those student loan companies, because they sometimes have funky rules like, hey, you had to have graduated from a school with a bachelor's degree. The student loan doesn't have to come from that, but sometimes they have these kind of funky rules. And so as you're kind of exploring those things, make sure that you're going through all the process, what's the requirements, to make sure that you don't get to the end, all of a sudden they're like, oh wait, we saw that you didn't have a bachelor's degree, we can't do this student loan refinance for you. So yeah, definitely refinance that at a lower rate. The tricky thing sometimes is, well, then what rate do we do? You want to try to pay it off faster in like 3 years to get a better rate, or 5 years? And that's where knowing where some of these other goals are important, because if you're only going to save a 0.5% by forcing a larger payment, it's going to be more tough. It's going to compete with some of these other goals that are coming up. 0.5% difference might not make a big difference in your finances at the end of the day, to give yourself more breathing room, still be making progress, still way better than the 10.5%. And all of a sudden you have a few extra dollars, a few $100 to throw towards another goal that is timely, coming up, and super valuable to you.
Nice. So I had a question about, so, for companies that offer stock, so either stock options, so RSUs, which is like basically stock that's granted to you and you invest. It's like, as soon as you start talking about this stuff, there's all these terms that like can't assume people understand, but like you invest kind of into over time. Employee stock purchase programs, like those are like some of the different things. How do you evaluate the value or risk of those things compared to like salary or like other kinds of cash compensation?
Yep. So cash is kind of king when you kind of compare it directly, because it's kind of given, locked in. The things with those options, again, because it's like, hey, you only get 25% of this in a year, and then you get another 25%. It doesn't match up exactly with if you get $10,000 in stock options, or you get to choose $10,000 more of income. The $10,000 of income will kind of come right away, and it kind of starts paying you every single paycheck through that year. With the stock options, the 10,000, one difference there is, well, if that stock goes up, it might be worth more than the 10,000 that it was today when it was first granted to you. It could also drop. So that a lot of people with this recent stock market drop since the new year, basically, like Amazon, Netflix, Google, all these companies have fallen like 10% or so. So that stock compensation that they thought they were going to get is 10% lower. Your salary is still stable, still kind of locked in. So there's pros and cons, kind of risk reward associated with it. There's the chance that that stock could go up by the time you invest. You also have to be there for at least 3 years or 4 years, depending on how it's structured. They're all structured a little bit differently. And they call stock options golden handcuffs, because that's why they give them to you, is to try to incentivize you to stay there so they don't have to train a new person and all of that fun stuff. And usually they give you some when you first sign up, and then a lot of times every single year they'll give you another batch and another batch. So you always have these dangling carrots out there. And if you believe in the company, if you believe you're going to stay there long term, being able to do that will definitely help. And again, it helps to understand, well, what number do you actually need just on a monthly basis to cover your expenses, cover your goals. That's usually where we start on the salary side for my clients that are given this option. So that's one thing that sometimes it's like, hey, choose this higher income or choose these stock options. And well, how long are you going to stay there? Do you believe in the company? But then also how much you actually need before we start relying on some of these things that are out into the future. Like how much income do you need right now? We want to make sure the salary at least covers that. And then you kind of have to back into what your comfort level is with the risk of the stock options. Employee stock purchase plans are different. That's what that is a discount. So you're able to purchase shares, and let's say a share is worth $100. You only have to pay $85 to get a $100 share, and you get that money. It's basically like free money essentially. And what I recommend for clients when they do that, but they don't want the actual risk of holding the employer stock because they think it's too risky, or they want to be more diversified, or they actually need that money to go towards a goal. You can usually sell it within a couple of days after you receive it, the employer stock purchase plan shares. And so you sell it right away and you kind of lock in that gain. So yep, you just made $15 using small numbers, but it's usually in like the $10,000 or $15,000 range that a lot of people will be maxing these things out at. So yeah, you end up making an extra $3,000 a year by doing this. It could essentially be risk-free if you sell it instantly. So that's employee stock purchase plan, because you can limit the risk and kind of avoid the risk and get that guaranteed amount. I try to get all my clients to pile in, max that out.
That's been in my experience. So yeah, the ESPP and the 401ks matches are just like free money. So it's just like take advantage of it if you can.
Yep. And that the employee stock purchase one, because of the complexities of it, is usually where people are afraid, like, I don't know what the heck this is. And they just don't know that they're missing out on. Usually what it equates to is about 1% to 2% pay increase at the end of the day when you max all those things out. As long as it's a decent plan, they give you a decent discount. You're increasing your salary 1% to 2%. And then yeah, it's still yours. You just basically save into account. For most places it's 6 months. They purchase the shares, you sell them, you get that money right back, and then you kind of repeat the cycle. And so you get the money, you can choose the money however you want to use it. You just have to be able to wait that 6 month period before you actually have access to it again. Perfect. I know we covered a ton, and let me know if anyone, I'm in the Slack group, so feel free to ping me if you have any questions. Probably for the next handful of weeks might be a little bit busier, so I might not be able to get back to you instantly, but I will definitely respond. I'll find out what resources I can send your way, and you can connect with me anywhere that you kind of prefer. Twitter is probably mainly where I am right now, but the Slack group works as well.
Cool. Thanks so much, Luke. Yeah, this was great. And I don't know how much, kind of experience you all have with this kind of stuff, but I know when I was starting off in tech, I had no idea about any of this stuff. And so I wish I'd had this session, 20 years ago when I was just getting started, because I'd be in a much better position at this point.
Yeah, definitely just use it as a starting point, right? Like probably a lot of things that don't matter or aren't necessarily relevant to you. Maybe you're just waiting for that kind of first official real paycheck to hit. Use this, it's recorded, you can go back and re-watch it again, and then start diving into some of these topics. So if you want to learn more about 401ks, well, there's a whole ton of resources that get very specific on that. And then as you kind of build these things out, you're leveling up, you build these kind of core foundations of knowledge, and you start to feel a little bit more confident on the financial side of things for sure.
Cool. Thanks so much for your time. Thanks for just, helping our community. It's great.
Yeah, well, and thanks for everyone for joining me. I know it's a holiday, right? St. Patty's Day, so
oh yeah,
be responsible, but have a fun night.
Cool.
Thank you.
Thanks so much. See you later.
Thank you very much.
Thank you.